All right, welcome guys to another episode of Real Deal Investing. We're joined here with our guest today, Bryan Cogliano, who is the founder of Revolution X, who specializes in Delaware Statutory Trusts, among some other things. Is that fair to say? 1031 exchanges, Bryan, right?
Yes, Larry, that's correct. We specialize at Revolution X in Section 1031 tax-deferred exchange planning consulting using Delaware Statutory Trusts, as well as some alternative investment options like bonus depreciation funds for a lot of our real estate investors.
Great, and I have so many questions about that specifically, but we'll get into that shortly. And obviously, we're joined with Jerron Kelley, my co-host and partner. Jerron, welcome.
Get used to the smaller screen here. So.
yeah. Cool. So let's get right into it. Bryan, tell us a little bit about your background and who you are, and start at the beginning.
Yeah, sure. Appreciate you, Larry and Jerron, having me on today. So thank you. And yes, so I've been in the business for about 25 years. I'm a certified financial planner, which in our field is kind of the gold standard designation. We act as fiduciaries for our clients. As I mentioned, earlier, the last time we connected on this, our practice is split really between Section 1031 tax-deferred exchange planning and consulting using Delaware Statutory Trusts. And then we have an asset management arm with a niche in alternatives. So we collectively manage a little over $1 billion of assets. And generally speaking, on an annual basis, we help our clients place a little over 100 million, somewhere between 100 to 200 million annually of 1031 equity in the Delaware Statutory Trusts.
Do you do traditional 1031? So just some background that our firm does a pretty high volume of closings. We represent a lot of regular investors who invest in residential properties, but of course, a lot of multifamily investors. So a lot of our clients use 1031 exchanges. It's pretty rare, I would say, that our clients have used the Delaware Statutory Trust. So I'm really interested in learning about this. We are not a 1031 exchange intermediary. Our office, we do help facilitate the closing with a 1031 exchange intermediary. But I think what I hear you saying is that your company Revolution X is a 1031 exchange intermediary. That's one of your roles that you have.
Actually, no, Jerron. So we are not qualified intermediaries, but we are members of the FEA, which is the Federation of Exchange Accommodators, and we have a very robust, set of relationships with a number of qualified intermediaries.
Great.
That when we have certain client engagements, if we need to make an introduction, we're happy to do that. But we ourselves are not and cannot act as a qualified intermediary because it would be a conflict of interest for the other side of the transaction that we're representing our clients with.
But you could work with pretty much any intermediary that a client chooses.
Absolutely. We work
layer on your services on top of the 1031. Correct?
Exactly right. I mean, we work with a number of recognizable qualified intermediaries. Often the QIs really like getting us involved because we can help their clients understand all their options. Being CFPs, it's not uncommon for us to maybe work on a fee basis or an hourly basis to help clients really understand all the options they have when they go down the path of the 1031 exchange. So many times QIs, if their client's in a situation where there's a lot of layers to the transaction, they might make a recommendation of a group like ours to consult them before they finalize any details of the transaction.
Perfect. Let's do this because I think sorry if maybe we're jumping ahead a little too much. We're kind of jumping towards the middle or maybe the end of what we need to discuss. For those people who are watching this who maybe are not super sophisticated investors yet, they're looking to get into the game. Let's first talk about what a 1031 exchange is. Bryan, do you want to run with that? And then let's layer on top all the different services that you might offer, the different planning that can be beneficial.
I think that's a great idea, Jerron. So Section 1031 exchange of the Internal Revenue Code has been around for over 100 years. And in essence, for simplistic purposes, right, a 1031 exchange allows a client of yours or ours to sell a property that's held for investment or business purposes and defer all the tax on the sale. So when I talk about deferring all the tax, we defer capital gains tax, we defer net investment income tax, we defer state income tax, and more importantly, for a lot of our clients, we also defer depreciation recapture tax. So for many real estate investors, there has to be a very compelling reason in our minds to sell a property that's been held for investment or business purpose and recognize all the tax. To have to give back 30, 35+% of your gain to start over, it does happen, but it would have to be a pretty compelling reason.
Yeah. I don't even know what those reasons are. I've had a few clients that, they don't use 1031s, and I'm surprised. I ask them in the middle of the process, do you have an intermediary? Do you have a 1031 company you're working with? And those handful of clients that say no, especially for the larger assets, I say, are you sure? Have you spoken with someone? Do you want to speak with someone about the benefits of it? Once in a while, they say, yes, I know and understand, and I just choose not to. Maybe it's some of them are close to retirement, and they want to use the money, and they want to cash out and do something else with it. But you're correct. Paying the IRS 35% or more, and especially paying back all that depreciation if you've owned the asset for a long time or done accelerated depreciation, can really get costly. So,
and as you guys know with your practices, I mean, we all work really hard to to help our client relationships, right? Build those relationships and give them, good advice, good experience. And I tell all the real estate investors that we have a chance to meet, competition's a good thing. Information's a good thing. And when you're going down transactions, it's okay to hit pause and just make sure you're doing all your due diligence. Get information from a group like ours so you really understand all your options before you finalize a decision versus, moving forward and then finding out, 6 months later, oh, well, if I would have known that was an option, maybe I would have exercised it.
Yeah, got it. So let's talk about some of the services that you offer on top of the 1031 exchange that you layer on top. That's your added value.
Yeah, thank you. So with 1031 exchange planning, most real estate investors are very much aware of 1031 replacement using active properties that they're going to continue to manage what we call the 4 T's: the tenants, the taxes, the toilets, and the texts, right? And what is amazing to me, and I've been doing this now for many years, but how many very successful real estate investors, even real estate attorneys that have not heard of or worked with Delaware Statutory Trusts. And Delaware Statutory Trusts are 1031 eligible investments that are actual pieces of real estate, right? So these are actual properties, institutional properties, where investors own shares of the property via 1031 exchange, okay? So what we do is we use Delaware Statutory Trusts for a variety of reasons in 1031 exchange planning, right? Let's say we have a client that maybe wants to completely get out of the active management of real estate. They've done it for many years, they've made a lot of money, and they want to be able to defer all the tax. They want to be able to preserve their stepped up tax basis for their heirs. They want to continue to get passive tax advantaged income. And maybe they want to diversify some of their holdings, right? Maybe they don't want to be all in one sector or all in one geographic region. Delaware Statutory Trusts allow all those features to occur. And I think what's even more intriguing to me is how big of a scale that sector is for real estate investors that haven't had any experience with it. Through August of this year, we're approaching $4 billion as an industry, $4 billion of 1031 equity into DSTs. So when we speak at a variety of different realtor conventions and broker offices, I always joke around and say it's the most popular scenario and strategy that you've never heard of. And usually once investors kind of understand the techniques involved, they're a little bit more proactive as they come into exchanges for themselves or for others. I always tell investors too, it's a great backup option for identification on an exchange, right? So I'm sure, Larry, both you and Jerron have a number of clients who've done multiple 1031 exchanges, and we all know how quickly 45 days can go, right? And for those that are tuning in today, when you do a 1031 exchange, the IRS gives you 45 days to identify replacement properties. And there's several different rules on replacement, but 45 days can go quick. And even if you're in love with a few active properties that you want to pursue and manage yourself, things can happen, right? We could get outbid, they could fail inspection, there could be some issues that pop up. Now all of a sudden, maybe there's 5 days left and we're really struggling to identify something that we really like, right? And right now, especially with the real estate market, as you know, supply-demand curve has been inverted for some time. There's just not a lot of inventory. So things might be a little overpriced for value for investors. They can use DSTs as a backup option. They can place their equity into some DSTs. And when the DST goes full cycle, they can 1031 exchange back into actively managed properties on their end if they chose to, right? So
I love that.
We see that happening a lot right now for a variety of reasons, right? There's obviously a lot of political uncertainty, tax uncertainty. The real estate market is challenging for a variety of reasons, but we have many investors who have made significant gains in their portfolio, and they're taking a look at everything right now and they're saying, hey, if I can take some of this equity off the shelf, so to speak, and I can defer all this gain and live to fight another day when I think the market might be a little bit more competitive, maybe 3, 4, 5 years from now, why not? We're seeing a lot of folks that are selling, utilizing our services for their bayfront, beachfront, highly appreciative, multifamily or apartment buildings that, timing is just right for them to look at other options.
Agreed.
How long does it take? So if you wanted to plan this for a backup, because I do a number of 1031 exchanges for clients, we help them do this. If we wanted to use this as a backup, how long does it take to kind of execute the DST version of the 1031 exchange?
Right. Good question, Larry. So as far as execution goes or closing of the DST, we can close in as little as 48 hours. Where the gamesmanship and kind of the game of chess comes in is when we're going through the 45 days and we have clients that are actively pursuing properties that they want to manage. When we're trying to come up with a DST as a backup option, we want to make sure that that DST is still going to have equity remaining at the end of the 45 days. So for example, if your client is identifying 2 properties that they really want to get, and for whatever reason, right, wrong, or indifferent, those properties fall through within the 45 days, the backup option that we have for the DST still has equity remaining, meaning it can still take the client's funds in the QI's escrow account to keep the transaction 1031 compliant. And just to put that in perspective, most DSTs could be anywhere from 15, 20 million to 100 million in equity raises. And it's not uncommon when the DSTs come to market, they could be available for 3 to 4 weeks or 3 to 4 months, depending on interest and volume. So what we always try to do is get to know the client, get to know their overall situation, their goals and objectives, specifically with this transaction, and make some recommendations for a backup, for a backstop on their ID sheet. So in the unlikely scenario that they don't execute on the properties that they really want to get, they're not caught with their proverbial pants down, so to speak, having to pay the tax man because we didn't have a suitable replacement on the ID sheet. Okay,
so there's multiple ways to do this, but let's use the classic method that most people go through. There's 3 properties they can put on the ID sheet in theory, right? And so maybe 2 properties, 2 actual physical properties they're putting on that they want to manage, and then the third one is the DST. Is that kind of how that works?
That's correct. And the 3 property rules generally is the one you see a lot in addition to the 200% rule. But you're correct. They could have 2 active properties that they want to manage listed, and then they could 1031 exchange work with a group like ours to get a recommendation on a DST to list as their third option. So in the event those other two properties fall through, they're still able to keep the transaction 1031 compliant.
So my clients that have used DSTs in the past, they spent a bit of time working and speaking with you about which DST to choose. To your point, it's more than just here, Bryan, right? Here's money. So what are the other factors that someone would consider when choosing a DST? What should they think about?
Yeah, very good question. Obviously, all DSTs are not created equally, right? So there's a lot that goes in on our end from a compliance standpoint, from our audits internally and with our broker dealer to look at all the deals and approve deals that we believe are, applicable for our clients. So for most investors, it's a combination of factors, right? Once we understand what they're trying to accomplish with their exchange, maybe the client is, really interested in a certain sector of real estate, or maybe they're really interested in a certain geographic region. They might even say to us, listen, I just want to get income. I need to get, dividend rental income to replace my relinquished property, and it needs to be at this level. What do you have that's on the higher income producing side? So there's a variety of factors that the client may have interest in kind of reviewing and uncovering that we're very proficient in through our due diligence process for all the different sponsor companies and deals that we approve on our platform. Larry, what I will say that can get a little tricky, and one of the more, I would say, popular strategies that a lot of your clients and prospective clients that may be watching this today really need to understand with DSTs is DSTs are a very, very good option for debt replacement. Most people don't realize when you do a 1031 exchange, you have to replace both equity value and debt at equal or greater values. So we have a lot of clients that will come and say, well, hey, Larry just sold my house. We sold it for $2 million. We had $1 million mortgage. It was paid off at settlement. So I have $1 million to complete a 1031 exchange. What do we have in inventory? What's out there? And they don't realize that even though the debt was paid off at closing, they still have to replace the debt on a 1031 exchange, right? So there's a number of DSTs that exist for that purpose. And DSTs offer non-recourse debt. And non-recourse debt is advantageous to most real estate investors, right? So that's a whole nother, I would say, segment that we could spend a lot of time kind of digging in the weeds with. But for simplistic purposes, just understanding that anyone that goes to complete a 1031 exchange, they could use a DST solely for debt replacement, and they could go find an active property that they want to manage with the remaining equity.
That's pretty interesting.
That is interesting. How does that work?
Yeah, that's what I was just going to say.
When are you saying put no equity in and you're just getting debt, or you're saying just max the amount of debt per equity on one deal and minimize it on another?
Yeah, correct, Jerron. It really depends on the client's situation, but what we'll do is there's a variety of DSTs that have non-recourse debt, and then there's also DSTs that we call zero coupon DSTs or highly levered DSTs that might have 85% loan to value on the property. So if a client needed to get $1 million of debt in the 1031 exchange to match up the debt on the relinquished property, they may only have to invest $150,000 of their equity in the zero coupon DST to get $1 million of debt service to match up the exchange.
And I'm assuming that type of DST would probably the IRR, the return on investment is probably a little lower than it would be on a traditional.
Absolutely, and hence the name zero coupon. There's no dividend or income that's received in essence by the investor, right? Then we have other non-recourse DSTs, debt non-recourse DSTs that might be anywhere from 25 to 50% loan to value that still might be paying out somewhere between a 4 and 6% dividend distribution with return and property appreciation on the back end. So really what it always comes down to, just like with both of your practices, it's really getting to know the client, understand their goals and objectives, educate them on all their options, maybe preliminarily draw them up some scenarios of how the 1031 exchange could look, which is with respect to equity and debt distribution, so they can kind of visualize all their options. Even if they're really in love with an active property, there might be a place for a DST either as a backup or debt replacement. And I'm continually surprised at how many really savvy real estate investors are unaware of both of those strategies.
Yeah. So basically, for other people that are listening, you can buy an active property and go into a DST and cover your basis there, right? Like with the 1031 exchange model. So you're paying, again, you're not paying any taxes in that moment. You're deferring all your taxes. So you can do both at the same time, I guess is what we're saying, right? Yeah.
That's correct. And even for some clients, Larry, that maybe depending on their situation, this comes up often, as I'm sure it does in your discussions, but maybe the clients have some pressing life goals or financial needs before they finalize the sale of the relinquished property. And they're saying that maybe they need to take a couple $100,000 of cash out at settlement, or as what we refer to as taxable boot. A lot of them aren't aware that, they don't really have to pay that tax if they don't want to. Depending on the terms of their property, they might be able to access a line of credit prior to settlement to take some of that cash out, not pay tax on it. And when we go to settlement and close, we pay off the debt with the bank, and then we just replace the debt with the DST on the 1031 exchange. So we didn't have to give back 30 plus, 35+%. And I'm also continually amazed at how many investors aren't even aware that that is an option, and they just willingly go to settlement, maybe for simplicity purposes, and just they'll work with somebody like Jerron or from somebody from Jerron's office or their QI and just say, you know what, we need $500,000, and they don't realize that they might have to take $800,000 or $900,000 of equity out to net $5.
Yeah, huge loss. Yeah, it really is. It really flips logic on its head here with, So I just know as a kid, I was brought up, with the idea that you're not supposed to, maximize leverage. You're not supposed to over leverage yourself. You're supposed to pay your debts off, and that's how you get ahead in life. And really, it's taken me to switch that gear in my head in the last few years to really understand that that's the tax code really does not incentivize that. And it completely de-incentivizes that. And you got to play by the rules of the game. And IRS has set the rules of the game up. And let's maximize our returns on investment. And sometimes maximizing it is maximizing your debt. So just like in that example you gave, Bryan. But
you're exactly right, Jerron. And that's where we really have a lot of passion in helping our clients understand all their options within the tax code, and really play a calculated game of chess on them, understanding all their choices, whether it's in a 1031 exchange or using DSTs or not, or even on some of our other offerings with bonus depreciation funds, which allow a lot of our clients to generate passive losses to offset passive income or passive gain for the tax year. That you'd be surprised, again, how many real estate investors aren't even aware of that particular strategy. Maybe they've heard of bonus depreciation. I'm sure many of them have done it on some of their own properties, but not maybe aware that there are turnkey funds that offer passive losses on a K1 to help manage offsetting passive income or passive gain, right? Passive gain could be a failed 1031 exchange. Maybe there was a client that really did everything they could to identify properties within 45 days, and right, wrong, or indifferent, it just didn't work out. When we have a failed exchange, instead of just willingly going ahead to pay that tax, our second option or our backup could be to evaluate bonus depreciation funds and see what type of investment in those funds would provide us with passive loss to offset that gain, right? So we look at all those things, and we really try to help all of our clients, make the best decision for their circumstances. The facts and circumstances always change, But I think where the problem is that not enough clients truly understand all their options.
Yeah, it's amazing how, to be honest with you, up until this point, I didn't even know some of these options existed. And I like to think of myself as a fairly sophisticated investor and a fairly sophisticated real estate attorney. And I deal with very high net worth individuals too. And, many of my clients may know about this, but I certainly wasn't aware of all of these different options, which is great. Can you just dig down just a little deeper on that example with the failed 1031 exchange, and they get, unfortunately, they've got gains that they have to pay for because the 1031 failed. How does that work with this depreciation fund?
Yeah, can you explain or define a bonus depreciation fund for starters, and kind of
what does that look like?
Yeah. Very, very good questions, Jerron and Larry. So under the 2017 Tax Jobs and Cuts Act, bonus depreciation was one of many things that came out of that administration, right? And bonus depreciation levels started off at 100%. This year in 2024, they're down to 60%, right? And they're scheduled to sunset like many things in the tax code in 2026. So there's a lot of uncertainty going forward here, which is another, kind of challenge with where we're at right now. But what bonus depreciation allows us to do, there's certain asset classes within real estate that qualify for bonus depreciation, leveraged bonus depreciation, where we can take a lot of the expensing up front to generate a loss. Right. So for us, we have a few sponsor companies that we've worked very closely with on the DST side that saw an opportunity for this type of an investment on the alternative side. And we have funds that invest in gas and convenience stores through sale leaseback, car washes, and things like hydro farms with Tropicana. Right. So these are all asset classes where, under 2024's multiple, if a client were to put $100,000 into one of these funds, they could anticipate somewhere between a 1.5 to a 1.7 loss multiple. So for every 100,000 they invest, it would generate 170,000 in passive losses on a K1. Those passive losses, Jerron, to your point, can offset a failed exchange, which is a passive gain. They can offset passive income. So let's say you have clients that have significant passive income from their real estate portfolio. They've done all their own bonus depreciation and cost segregation exercises, but they're still showing income. This could be a plan for them. And last but not least, Larry, let's not forget all of our relationships that qualify as a real estate professional for income tax planning purposes. Those individuals also can benefit from generating passive losses in a bonus depreciation fund. So that's just one part of the story with these funds, Jerron and Larry. The other things I like about them is we're using otherwise spent tax money that's a guaranteed loss and gone forever in a fund now that we have equity in that's giving us a dividend distribution. And the beautiful part is the flexible exit. So at the end of the term for the fund, which could be anywhere between 4 to 6 or 5 to 7 years, depending on the sponsor company and the fund, the flexible exit options. The funds allow the investor to have their limited partnership shares go into DST shares, meaning they can then do a 1031 exchange if they want out of the fund into any other replacement property that they want if they choose to. Or they could stay in the fund, or they could decide they want to cash out. But most of our investors don't do that because of the tax ramifications are so significant. But really, at the end of the day, I think what it comes down to is everyone's, kind of going back to my analogy before, everyone's facts and circumstances are different. I always recommend that we have a call with their CPA to really understand their passive income, their passive gain, and then dive into the 3 different bonus depreciation fund offerings that we have access to that expire at the end of October. So October 31st is the deadline for funding because the sponsor companies have to go out and purchase the properties to put them in service before the end of the tax year. So I always say, let's do some due diligence with your CPA. Let's understand what your passive income, passive gain looks like and determine if these funds make sense for you. Now, the other thing that we're seeing here, because of the uncertainty with the Tax Cuts and Jobs Act, is passive losses can be carried forward, right? So next year, under the current law, bonus depreciation goes from 60% down to 40%. So the multiple for many investors is not going to be nearly as attractive. We have some investors that are making bigger contributions into this year's bonus depreciation fund offerings because they know they can use the passive losses in future tax years.
That makes sense.
Explain the last comment you made about the relationships for real estate agents, as an example, or people who are active in the business, and how
Right. Good question, Larry. So for many successful realtors and brokers, when they do their tax returns with their CPA, they qualify as a real estate professional for income tax planning purposes. And when you qualify as a real estate professional for income tax planning purposes, you don't have to delineate between active and passive income. So for many really successful brokers and realtors that have, very strong income years, this is certainly something that they should evaluate, right? So on one side of the fence, when they're working with their CPA, they're doing everything they can through their practice, through their business, to take all the necessary expenses and deductions that they can, and then they get to a point where they've swung the bat as hard as they could there. Then once they finish that, maybe they have a solo 401k plan, profit sharing plan, cash balance pension plan, where they're trying to put as much of their income in there to get a deduction for as well. A lot of times once that's done, there's still a big piece left. This is where the bonus depreciation fund could ebb and flow to the extent that they want it to, based on a contribution that they would make for that tax year.
I don't know if you have the answer to this, but historically, Jerron and ours move has been accelerate the depreciation on assets that we buy before the end of the year. So own an asset. So this is similar on some level, or how does that?
So accelerated depreciation and bonus depreciation are synonyms, right? So okay. Everybody that's in real estate is kind of doing that themselves with their own portfolios, as you just mentioned, as you should, right? As you're doing cost segregation exercises as well. Exactly. And a lot of times what ends up happening is as your portfolio grows, as your net worth grows, you've swung the bat as hard as you can with your own portfolio, and you're still having additional passive income that you can't shelter. Right? So this is where the bonus depreciation or accelerated depreciation funds could be an option to evaluate, to rule in or rule out, versus what we always tell our clients, hey, if you want to guarantee, don't do any tax planning and just pay the tax. That's guarantee loss, right? That money's gone. We're not getting a dividend on it. We're not reinvesting it. So before we make that decision, let's invest 30 minutes to have a call with your CPA and look under the hood at these fund offerings to see if they would fit your facts and circumstances.
That's awesome. That's awesome.
Yeah, that makes sense. Let me ask you a couple questions about the DST assets. I'm assuming these are not assets that you're managing. I'm assuming these are assets that are other syndications are putting together. Syndicates are bringing to you. You're vetting them. You're seeing what their track record is. Tell me if I'm barking up the right tree here. And
Jerron, you're exactly right. So first off, we acting as fiduciaries, right? We're very transparent, agnostic. We're completely independent in the due diligence and compliance process. So unlike certain folks that might be in a similar sector of us, we do not take ownership of any of the properties. We have no influence with any of the syndicators or sponsor companies' leadership or management team, right? On purpose, because we're sitting on the same side of the fence as our clients are as we go through the process of really understanding each one of these offerings, right? There's, 40, 50, 60 different sponsor companies out there. There are certain ones that obviously have been around a long time, that have very, very good track records, right? Very strong leadership and management teams. And then there's other sponsor companies that are really trying to emerge and, gain traction in the space, but they just don't have the experience. They don't have the track records to reference yet. But they might have a deal that's worth considering, or they might not, right? So our job is to kind of do that. We have our proprietary process that we do internally with our broker dealer. So if we approve a deal on our platform, it's something that we feel very comfortable with. And we always tell our investors, 1031 DSTs are not investments that are going to double your money. The returns that a real estate investor are going to get by managing their own property could certainly have a higher risk reward profile. Most of the investors that we deal with, they want to know that they're going to get moderate to modest dividends and moderate to modest property appreciation, and they don't have to deal with any of the other headaches, right? They're a passive investor. A lot of our clients call it mailbox money, right? And they're not interested. They've swung the bat to do all the things over the years with the tenants, the taxes, the toilets, and the texts.
Got it. And
I've had friends who have chosen to go the route of investing in syndicated deals over the years. They're not in the real estate business, but they're savvy enough to evaluate some of the different syndicators out there and make some decisions and invest some of their money there. And they've soon they will be receiving a lot of gain on this when these guys eventually sell, and it looks like that's coming up here. Some of them have sold already, but so for somebody who is invested in syndicated deals, this also could be a pretty good option, right? They can 1031 out of the syndicated deal into a DST. Is that fair to say, or?
Yeah, so it'd have to be specific to the deal, but assuming the investment you're referring to is 1031 eligible, right? When they sell it, if it's a 1031 eligible investment, then yes, all the DSTs would be in play. And I will say this, because this does come up, we do have a lot of ultra fluent clients that obviously are passionate about real estate, right? And there's many clients that actually will put cash in their portfolio into certain DSTs. Now, not all DSTs will accept cash investments. Most are just 1031 eligible investments, but there are certain deals, certain sponsor companies that'll take cash investments. And I'll give you an example. We had several high net worth clients that were alumni from the University of Notre Dame. Notre Dame's student housing portfolio came out several months ago with an offering on the DST side. So we had on-campus living student housing at Notre Dame. I think it was like a $40 or $50 million raise. And we had a number of investors that were not necessarily 1031 investors, but they were looking at their traditional security portfolio. Equity markets have been running hot for a little bit. There's some political uncertainty. They said, you know what, it'd be nice to have a little sleeve into something a little bit different. And they would do maybe $50,000, $100,000 increments just to get the exposure. And also, I think for a lot of them, because they're alumni, right, it was something nice to talk about on the golf course or at a cocktail party. So we do have offerings like that I think would for certain investors be good to know exists.
Got it. Could you tell us, I know every investment is different. I know every offering memorandum is going to have different numbers, but what are you seeing out there for returns, either dividend estimated dividend returns per year or IRR percentages? What are you seeing out there in some of the deals that people are getting into and that you're offering?
Yeah, great question, Jerron. So right now on the dividend side, I would say that the spread on the dividend distribution amongst all the sponsor companies is anywhere between 3.5% to 7% in dividend distribution. Now, keep in mind with the DST, those dividends are paid monthly. So if we have a client that puts $1 million of equity into a series of DSTs that's paying, let's say, 6% dividend distribution, right? That's $60,000 a year or $5,000 a month. That's ACH to their checking account every month. You don't have the option to reinvest the dividend. You have to take the dividend out.
Okay.
On the property appreciation side, it really depends on the sector. Most of the DSTs, like I said earlier, are moderate investments. So they're looking at anywhere from 3 to 6, 5 to 7% property appreciation per year. So on the total IRR side, you might be anywhere between 8 to 15% annually between the number of different dividend or the DST sponsor companies, right? That also is a function of the sector of real estate and the approximate hold time that the sponsor company is targeting before they sell the property, and then the investors are back at the table to do another 1031 exchange, either back into DSTs, back into active properties that they manage, any combination of the two, or as we refer to it, swap until you drop.
So you could come back out of the DST and get back into your own property. So the example that I could see happening a decent amount for some of my clients who they're scrambling at the last minute. They're at that 35-day mark, 40-day mark, and they're trying to identify those properties. And maybe they've identified one, but they have an inspection period and they don't know if they're really going to like the property. They could work with you. They could put a DST on their 1031 exchange list. Then let's say that property doesn't work out. They then put the money in the DST. Let's say the fund is a 4-year fund, hypothetically. At the end of the 4 years, they could then 1031 that money back out into one of their deals and go back to being an active investor, or any other option, putting it into another DST, et cetera. But they have all those options available to them. Is that correct?
Yeah, precisely. Exactly. And a lot of times what we see for those scenarios is really two things. One is a client ran out of time, right? The 45 days was coming up. We get calls across the country. Hey, Bryan, I'm in day 42. I hear you're really good at this. Help. What do you have? We're stuck, right? So that's one option that we see a lot. And because they were stuck, the intention on the design is to try to identify a DST that maybe is on the shorter side of hold time, so they can go back into the game, so to speak, themselves and handle their equity however they want. The other option that we see a lot outside of that is we have clients that are in a position right now where they can really get a premium for their property, right? Because there's not a lot of supply. Maybe they never really wanted to sell because they always thought they were going to get hammered in taxes. Now they know there's another option and they can get a premium. So they're going ahead to finalize the sale. They're preserving their step up in basis. They're deferring all their tax. They're getting, in many cases, the same or more tax advantaged income. And then they're just going to play it by ear down the road. Hey, if there's something that they really like, that they want to go manage, great. Otherwise, they're comfortable wearing the passive investor hat and kind of riding the wave where it takes them.
That makes sense.
What's the shortest DST time frame or hold time frame you've seen?
Yeah, so right now there is one particular sponsor company that's targeting a 3-year hold time, but they also have some provisions in there for 12-month extensions if needed. But I'd say, generally speaking, 3 to 4 years is on the shorter side. I'd say more average industry is in that 5 to 6, maybe 6 to 7 year time period. With that being said, we've seen scenarios play out on both sides of the spectrum. We've had very, very good sponsor companies target a 5-year hold or a 5-year, full cycle. And we'll get a phone call at the end of year 3 saying that they got a, phenomenal offer on the property. We actually had one in the state of Florida not too long ago with a multifamily development that was targeted at a 5-year hold. They ended up getting a number that they really liked in year 3, and the investors got well over 20% IRR. So you see that happen occasionally. Obviously, the markets were different several years ago than they are now, right? But you also see the other side of it. Let's say they target a 5-year hold, and now we're in year 6, and we have some investors going, "Hey, Bryan, what's the latest here? Give us, give us an update. What's the sponsor company seeing?" And the sponsor companies are managing the properties also as a fiduciary. What's in the best interest of all the investors? And if there's certain headwinds or tailwinds in the real estate market, that's just not a good time for them to sell, and they're just not getting a number that they think, lines up with their pro forma, then they don't have to sell. They'll continue to manage the property. It's cash flowing, and they're just going to wait until everything kind of lines up. So you have both sides of the spectrum.
Yeah, I think a lot of these syndicators are waiting for rates to drop here in the next 6 months or so, and have some buyers come back. So, but yeah. And then I guess last question I have, because it's just a natural question that I'm sure some of the viewers will have, is how do you earn your fees, and what do those look like?
Yeah, great question, Jerron. So in our business, right, there's three ways in which we can earn compensation, right? One way, depending on the client engagement, is we can charge fees, consulting fees, flat fees for our involvement in the planning process, right? The second way we earn compensation, which I would say is generally the more common way on 1031 DSTs, is we get paid a commission finder's fee directly from the sponsor company for placing the equity. And as I mentioned before, because we're completely independent and agnostic with no ownership interest in any of the sponsor companies, we don't have any different compensation packages across the sponsor companies. So on our end, there is no bias to recommend one particular deal over the other, because the compensation that we get paid directly from the sponsor company is the same. And that compensation is generally baked in to all the DST offerings, right? So if a client contributes $100,000 or $1 million of real estate equity into a DST, their statement is going to show that they own $1 million of equity or $1 million of shares in that property. Okay. Third way we get compensated, arguably the most lucrative, Jerron, just like your practice, and Larry, just like yours, is word of mouth, right? Recommendations, referrals. What we want to do is build relationships with our prospective clients to be a resource for them, not just for this transaction, right? Hopefully for many years. And assuming they have a really good experience, there's probably 2 or 3 people that they might introduce us to that would have similar facts and circumstances and could benefit from our knowledge, experience, and resources.
That's great. And so I think what I'm hearing is there are certain scenarios where someone could come to you and they don't pay $1 out of their pocket to get your services and to put them in a DST and save them from 35% going to the tax man, because you're getting compensated from the sponsor, correct?
That's correct.
Okay, that's great.
And for anyone who's listening, though, there is, if you're doing a 1031 exchange, you do need to have an intermediary, right? Mm-hmm. If you touch the money, you pay the taxes. So an intermediary will charge a fee to facilitate that transaction, which will cost. Bryan, what are you seeing right now for an intermediary as far as fees? What's the range?
Yeah, Larry, the fees are very nominal.
It's small.
I mean, generally speaking, it could be anywhere from $750 to $1,000 or $2,000, depending on the complexity of the transaction. But for colleagues of yours, Larry, and your side of the fence in the transaction with your relationships, and I know Jerron with what he sees at his office, it's always good to talk to the prospective seller and say, hey, have you thought about a 1031 exchange? Even if they're only, 24 to 48 hours before settlement, we can generally get a QI in place, even if they're not 100% sure, right? Because I've told clients numerous times, listen, if for nothing else, that $750 or $1,000 fee to the QI is going to buy you 45 days to spend more time to understand your options if you want a 1031 or not, right? So it's very, very, I think, good practice for anyone that's selling highly appreciated real estate or real estate where they've taken a significant amount of depreciation and the property does qualify for 1031, right? Get a QI involved before settlement. It gives you more options, right? Even if you're not 100% sure about what path you're going to go down, it's always nice to have flexibility.
I bring up the 1031 exchange to so many people, and what's interesting is most brokers don't bring it up, and usually when I bring it up in a listing appointment or presentation, or even on an intro call, some of the sellers aren't aware of it, some are, but as soon as I bring it up, they quickly see me as an authority figure, like that I understand how this works, and they become very interested. I usually win appointments based on referring them to either QI, and I have your information obviously as well, as recommendations on different options that they should consider, and then that they should talk to their accountant as well in this process, this decision-making process.
You're adding value there, Larry, and people love working with people who add value. So,
yeah.
Jerron, you're exactly right. I was just going to say, when we do these types of presentations, in the Mid-Atlantic region, I always tell the realtors, you think about how competitive, and Jerron, even in your practice, right, how competitive your business models are. And at the end of the day, what are you going to do to differentiate yourself from your competitors, right? It all comes down to value proposition, right? Your team, your resources, intellectual capital that you can bring to the table for your relationships. You work so hard, to build those client relationships, and the clients deserve that type of, opportunity.
Agreed. Yep. And they deserve that information, because they may not know that they don't have to hand over, they're selling $1 million investment property, a home that they've had for years, and they shouldn't have to pay the IRS $350,000. If they want to, that's fine. Great. But
and Jerron, I'm going to give you and Larry one more scenario on that I think might be applicable, especially because of the experience I have in working, a lot in Florida. We had a client that was referred to us, where the mother left the 3 children a beachfront property with an adjacent empty lot. And the kids for years they all lived out of state. They would come down for a few weeks and use the property, and they grew up there as kids, and there was a lot of sentimental value, et cetera, et cetera. Well, long story short, they got an offer to sell both the house and the lot next to it. Let's just say for a significant amount of money, over $8 million. Okay. Before they agreed, the realtor involved said, well, wait a minute. I think you should talk to Bryan so you can understand all your options with this. Well, fortunately they did. And when we had a chance to really understand everything, what we determined first and foremost was the property was not 1031 eligible, right? If they were to go ahead with the sale, based on the residency that the kids lived in, they were going to be close to 40% tax rates on the sale of the property, which way back when, and Jerron, your office, especially in the estate planning side, might remember this, but there was a big trend years ago where mom and dad would deed the title of the property over to the kids for $1, right? And one of the challenges, obviously, when you do that, when mom and dad make a gift or deed something for $1, the children inherit that gift basis. So the kids had no basis, huge gain. Long story short, we worked with their CPA. We took time, roughly 2 years, to bolster the property to make it 1031 eligible, right? We rented it out. We had a realtor help. We showed income and expenses. And long story short, we worked with the same buyer and the same realtors on both sides, representing our client and the potential buyer, to keep that deal alive. And it ended up saving the children close to $4 million in taxes. And I always joke around with them when I see them. I say, what more could you have done over 24 months to make $4 million, right? So a lot of times these families, and especially the owners of the properties, they just don't understand. They don't understand, Jerron, to your point, all their options. And I would tell you that there's a number of people out there that you can help, that before they finalize a sale, and if there's significant fact pattern to support it, let's see if we can make the property 1031 eligible. There's lots of reasons why it might make sense. Yeah,
especially with some type of basis like they're dealing with there, and taxable event. So that's huge savings.
I know investors that play the game of using homesteading properties in different areas, and but they're investing there, but it's their investment, and that creates a hurdle on the back end, right? So it's something that I forewarn people about quite a bit when they're thinking about doing this, and think about the end of this process. What's the exit strategy here?
Exactly, Larry. And keep in mind, on the homestead side, with the IRS, you have what's called the Section 121 exclusion for primary residence, which currently, if you're married, filing a joint return is $500,000. singles 250. We see a lot of times there's folks that have property that's held for investment or business purposes on the same property or land as their primary residence, right? So there are certain scenarios where we can work together and use 121 exclusion with 1031 to make the client's outcome even more robust. You don't see it as much as your traditional forward exchange, but I just wanted to mention that since you brought up homesteading.
Yeah. That's interesting.
Yeah.
Okay.
Well, it sounds like you have some real creative arrows in your toolkit there. So yeah, in your quiver. Good. Well, that's all the questions I have. This found this to be very informative, Larry.
Yeah, this was a great overview. Obviously, for any specific situation, we need to sit down, have a call, and talk with Bryan. I mean, this is a good just starting understanding of this process. Bryan, anything else you wanna leave us with?
Well, listen, I have a lot of respect, Larry and Jerron, for your practices, and obviously we've had a chance to know each other prior to this call. So I look forward to the opportunity to doing what I can to help any of your existing clients, prospective clients, just get information, get options. Feel free to reach out. Looking forward maybe to coming back and joining you guys in the future for another podcast. But obviously, in the meantime, if there's anything that does come up with any of your existing clients or prospective clients, I'm happy to help.
Awesome. Where can and we'll put your contact information in the video, obviously in the description, et cetera. But for anybody who's listening, where's the best place for someone to reach out to you? Is it email, phone number? Yeah.
Yeah, exactly. I would say either way. I would say feel free to send me an email, maybe reference that you're an existing client or a prospective client of Larry or Jerron, or feel free to call my office and leave a message. And then that way we can coordinate schedules effectively. So I have a chance to maybe learn a little bit more about your situation.
Awesome. And I assume you offer a free consult for people.
Absolutely. I mean, listen, at the end of the day, it has to be a fit for both, right? And there's a lot of times, and I'm glad you brought that up, Jeremy, because a lot of times we talk to people who really think that they can do a 1031 exchange and they want to do a DST. And once we get a chance to really understand all the moving parts of their scenario, we'll tell them that they're really not a candidate. It's not in their best interest. Maybe they're not an accredited investor, right? Which in order to do DSTs, you have to be an accredited investor. And a lot of folks don't understand, maybe all the moving parts of their situation. They saw something, they read something, they think this will fit their situation. But once we have a chance to talk through it for 10 or 15 minutes, we're generally the first ones to tell a prospective client, hey, you know what? I think you're better served going in this direction, and here's why.
Makes sense. Yeah.
Awesome.
Absolutely.
Appreciate that.
Well, thank you for your time, Bryan. This was very enlightening. Yeah.
Yeah. Thank you, Jerron. Thank you, Larry.
Awesome. Well, thank you everyone for tuning in to another episode here. Bryan, again, thank you. Jerron, thanks. And we'll see you guys on the next one. Feel free to like and subscribe if you got some value. See you guys.